Hello, very good morning to all, and I hope that you guys have a restful and great weekend. Very good morning. Today will be a brand new week, and today will be Monday, the 29th of July 2024. And very good morning. Welcome to today's Daily Dose of Market Insights. I'm Kelvin here. So before we start our Daily Dose of Market Insight for this week, as we know that this week will be a big week, later I'll share with you why on the economic calendar. Let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exit deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so before we jump straight into the short-term technical outlook, let's have a quick recap what has taken shape on Friday and as well as this weekend in terms of the relevant important news release, data flow, and as well as their impact on the various cross asset classes, and as well as we have a quick discussion about the current fundamentals and medium-term intermarket dynamics that are at play. So in terms of the news flow and data releases on Friday, we do have the all-important US PCE data. So why this data is important? Because this data is the last data that the US Federal Reserve will have in terms of key economic data before they make the decision or provide new guidance on their monetary policy going forward this Wednesday. So let us say why this week is important, because we do have the US Federal Reserve monetary policy. I'll touch more about that, but let's have a focus on what the data is pointing to us on last Friday in this core PCE data. So for the core PCE price data year on year, it came in within the same rate of growth as the previous month of 2.6% year on year. Market is expecting a slight dip to this 2.5% year on year, or about 1 basis point lower, but it didn't actually came in with market expectation. But that also don't see a kind of a resurgence of inflationary pressure, and it continues to remain below the 2.8% since hitting it on February 2024. All right, so if you look at the 5-year trend of the core PCE price index on a year-on-year basis, is clearly showing a path of deceleration. So even though what we see that it didn't actually meet market expectation of 2.5%, it also didn't tick upwards as well. So that actually did not change the trajectory or the pendulum of what market is actually pricing in what the Fed is about to do or potentially will do going forward, as implied by the short-term Fed funds interest rate futures market as compiled by the CME Fed Watch 2. All right, so this CME Fed Watch 2, for those who join us on a very frequent basis, this shouldn't be sound quite unfamiliar to you guys, because I've been using this as a tool to gauge what market is currently pricing in on the monetary policy stances as we call it decided by the US Federal Reserve. So let's go to the probability over here, and let's look at the combined probability. So market is still not looking for any chance of interest rate cut by this Wednesday. All right, that means this week FOMC meeting, they are looking at it stand pat. Why? Because on 31st of July, so that's this week FOMC meeting, the current Fed fund rate is at 5.25% to 5.5%. So market is still expecting close to no change for about a year or so already, at 96% high chance. So right now, if the Fed were to actually surprise the market by cutting 25 basis points on this coming Wednesday or this coming week on 31st of July, for sure that could actually cause the US dollar to actually weaken by a fair bit, because there's a surprise cut by the market. And the US stock market will be very dependent on how the Fed going to portray this cut during the press conference. Why? Because a surprise cut by the Fed indicating to us, because what market is not expecting a cut this week. All right, so if the Fed were to cut on this particular week, it actually tells us that the Fed knows something that the market does not know, because at this moment in time, based on the current economic data that I share with you guys, is not showing signs of a recessionary yet. It's more of a soft landing scenario with a slowdown in inflationary trend. So if the Fed were to be panicked and start pressing the button ahead of what market is expecting, it tells us the Fed knows that the economy is not doing well, and that could actually potentially create a risk-off impact on the US stock market. So what we could see, we could start to see those high-flying stocks that is high value, like the mega cap stock, starts to fall off a fair bit. But however, those stocks that are kind of pretty much we call it supported by the bull steepening, later I'll share what's the bull steepening again of the US Treasury yield curve, could actually benefit or fall down by a lesser magnitude or even go sideways. Those are actually stocks that are heavily concentrated in the Dow Jones Industrial Average and the Russell 2000. All right. So what current market is looking at, high chance of only the first cut to actually come in the September meeting, 18th of September 2024, which is a high chance of 85 basis point cut, 85% chance of a 25 basis point cut, pardon me, to bring it down to 5% to 5.25%. Then thereafter, right after the US presidential election, we do have another cut again of 25 basis point with a high chance at 84% to bring it down to 4.75%. Then followed by, before the end of the year, 18th of December, another relatively high chance as well because it's more than 50%. 79% to bring it down to 4.5% to 4.75%. So what market is looking at right now, after the release of the latest core PCE data on Friday, they are still looking for a high chance of more than 50% chance of the Fed to actually cut or potentially cut, I would like to use the word correctly, by 3 interest rate cut of 25 basis point each before 2024 ends. So that is actually slightly much more dovish than what the latest dot plot that was kind of inspired by the or projected by the US Federal Reserve, because they're only looking for 2 interest rate cut on the median forecasted basis or projected basis. So for sure, the pendulum will change again when it comes to this September, because this September itself, the Fed will also release the latest dot plot. So until then, we will have a better picture, or even before the release of the latest dot plot, somewhere around in August, we will have a latest slew of Federal Reserve official speaking or guidance from that. But at this moment in time, it's still rather dovish, all right, from there. So given such dovish expectation on the US Federal Reserve, we do see on Friday the dollar strength that is coming kind of being kept as well. So if you look at the dollar index as per se over here, we see it's trading almost sideways for the entire last week or so on last Friday. So it can't actually shape a break up above the 200-day moving average. Right, the 200-day moving average. So net overall, that actually kept dollar strength on the average basis. Why? Because this is a dollar index. All right, individual pair may move differently by a different magnitude, but you put everything together based on the dollar index, there is no clear signs of a dollar strength movement last Friday, as being we call it supported by the dovish expectation portrayed by the expectation of how the Fed were going to guide the market using the CME Fed Watch tool as a guidance. All right, and also with that, we start to see both the 10-year and the 2-year US Treasury yield going to inch downward on last Friday. So last Friday, we do have a second day of bearish reaction right below the 4.28% or 4.33%. Also, the moving average acting as a resistance zone as well. That is confluencing by these 3 moving average, the 20-day, the 200-day, and the 50-day moving average. So this is the US 10-year Treasury yield. So on last Friday, we do have a second bearish reaction day. All right, and on a shorter term basis, the 2-year Treasury yield also inched downwards as well on Friday itself. And now, at the start of this week, of course, today's this based on the current Asia session, is now looking to actually break below last week low over here. Okay, so now this will become a pullback resistance. Okay, the previous swing low here, the 4.42% will become a pullback resistance. So what we could see over here is that the price action, oops, sorry, try to push it down, yeah, to here. So looking to test break below last Thursday low as well. So net overall, what we could see over here is that the US Treasury yield, both on the 10-year and the 2-year basis, continues to inch downwards. All right, so that actually supports this dollar strength that remains kind of sideways yesterday and more skewing towards the bearish side of the story, because it can't break above the 200-day moving average, I think, as a resistance. Okay, back to the dollar index again. Okay, So this is what I mean. Okay, so now in terms of the US stock market performance on last Friday, so we could see on last Friday all the 4 major indices actually closed in the green or close in the black, we call it positive. So but the top performers still actually being concentrated on this year laggards. We mean by laggards, that means those value-oriented stocks, those small caps related stocks or proxy. The Russell 2000 and the Dow Jones Industrial Average outperformed last Friday, 1.67% for the Russell 2000, almost the same magnitude on the Dow Jones Industrial Average, 1.64%. And we have almost 1% each on the Nasdaq and the S&P 500. So the Nasdaq is up 1.03%, the S&P is up 1.11%. So if you look at the heat map on the last Friday S&P heat map, almost all of them are in the green, all right, which is positive. But if you were to actually, okay, give me a minute, I think what did I did over here? Okay, yep, good. Okay, I rearrange it. So all of them are close in the green. But if you look at from a 5-day perspective, so I go to this breakdown over here. So what I could see is that this is the last week performance. So last week performance, the top performer, right, are actually the value-oriented and the cyclical stocks. The utilities, materials, healthcare, financial, all closing gains of 1.3 to 1.5%. This was last week weekly gain. And at the bottom of it is your information technology stocks, which is your mega cap stocks as your communication services, where Meta is also part of them as well. So what you could see over here is that those mega cap stocks that has a significant weightage in those, we call it a higher in the previous sector, consumer discretionary, where Amazon is there as well, followed by Tesla. Information technology, we have a slew of Microsoft as well. Then communication services, we do have Meta inside this particular sector. So those particular sector that has a high weightage of being put away, being contributed by the mega cap technology stocks, all of them actually underperformed last week, not even positive territory, but in losses of more than 1% each, all right, at negative 2%, negative 4%, and even negative 3.7%. So if you look at from a monthly basis over here, it's also the same slew of performance as well, where the oops, why is it showing gray out? Okay, let me refresh again, pardon me, because the internet is a bit slower while I'm speaking, so I think they can't capture it correctly. Okay, let it wait for a while. Okay, oops, there's the advertisement being pop up. Okay, good. Okay, so over here from a 1 month basis, right, you look at it over here is that the value related component of the S&P 500 sector, because it's breakdown according to sector, actually outperform. So the real estate is up by 7.6%, the financial up 5.6%, industrial up close to 4%, 3.7%, followed by utilities 3.4%, and even the materials up by 3%. And what we will see over here is that the mega cap stocks that are heavily weighted inside these 3 sectors, the consumer discretionary, the information technology, and the communication services, all of them are down for the month at negative 1.5%, negative 3.9%, negative even 7% for the communication services sector. So very clearly, we start to see that it's a stuck performance of the value and small cap stocks that is now outperforming due to a more dovish Fed that lead to a bull curve steepening or a bull steepening of the yield curve, which I later will touch on earlier. For those who followed my daily dose since 2 weeks ago, you should be able to know what is this bull steepening about and how does it impact the major US stock performance. So going forward, from a multi-week perspective and even a multi-month perspective, potentially we will start to see those laggards, Russell 2000 and the Dow Jones Industrial Average catching up, and where else we start to see underperformance of the mega cap technology stocks that are heavily weighted inside the Nasdaq 100 and as well as the S&P 500. All right, so this is the performance that has taken shape on last Friday. And what happened on the weekend over here is that we do see a particular news flow that's more related to the trade tension between the longer term between US and China, regardless that which president election nominee is being we call it heading into the White House in November. So what we could see over here is that China continues to, okay, this is actually this remark was actually made by the Vice Finance Minister Liao, that he said during last weekend G20 finance meeting. So China defends herself on her manufacturing push. So this is what she wants right now in her long-term economic growth plan. When the conclusion about last week, the third plenum, no more high asset allocation or high resource allocation to the consumer domestic sector via the real estate as a wealth enhancing tool. But right now, the China top policymaker is going to push in high-tech industrialization, concentrated on getting the know-how and the resources, and as well as the actual product relating to high-end semiconductor chip manufacturing and the process, clean energy, which is focused on the EV, electric vehicle, and as well as biosciences. So China, during the last weekend G20 finance meeting, the one of the inner circle of the top policy makers in China, which is the vice finance minister, one of them, part of the group, the core group, he mentioned that China will continue its manufacturing push to be the number one electronic vehicle in the world. That means he claimed that the world needs more EV. So do not forget, in the last few months, the whole world right now are against China EV flooding their markets, because they claim that China is actually undercutting prices, causing profit margin compression by their respective localized automobiles company. Like in US will be Ford and General Motors. In the European will be, we're talking about Volkswagen also, all right, and potentially in Japan we talk about Toyota or Honda. So right now, if China will continue to be very persistent in this push to be the number one EV car maker, not even local but globally, that could actually create more trade tension going forward in the longer term. So regardless who wins the president election, be it Harris or be it Trump, this ongoing trade tension in between US and China, and perhaps against the rest of the world, will remain intact, and that potentially could actually lead to negative feedback loop into the China related stock market, the China stock benchmark index, the A stocks, because the China government is no longer concerned about creating a bull run in the China stock market, because they're now focusing more on industrialization instead. And potentially the Hang Seng index, which is also a proxy of the related to the China stock market, will continue to languish in a sideways fashion from a longer term perspective. Right, so that sum up the news flow perspective over here. So now let me right now focus more on the fundamentals and the intermarket dynamics that is playing out in the global markets right now. All right, so let us focus more on the US Treasury yield first. All right, starting with this particular thing over here. Okay, so I want to focus one which is related to the gold price. All right, so now at the top of this chart over here is the daily chart of the US Treasury real yield. So what I did over here is that I just get the nominal US 10-year yield minus off the 10-year inflationary expectation that is being portrayed by the 10-year break-even rates. So this gives us a kind of forward indication where the US 10-year real rate will be. So this gives us a better opportunity cost of holding gold. So as you all know that gold itself is a non-fixed income asset. That means for long-term gold buyers, if you hold on to gold, you put it somewhere, it will not give you any interest income at all. All right. So if the real interest rate in the world continues to inch up higher and higher, that could actually increase the opportunity cost of holding gold, which is in a long-term to medium-term perspective is detrimental. I mean, it does not support any further uptick in gold, but provided that we start to see geopolitical tension rising. Okay, so as we know that now, geopolitical tension more or less remains the same kind of dynamic at play right now. In between what happening in Gaza, it has already happened. So it continues to play out. All right, so it's going to lock within that region. The Red Sea region also, we start to see the potential disruption in shipping routes that more or less has already been known to the market. All right, so now what is being not unknown in the market is the potential continuation of this depressing US 10-year US Treasury yield. So this real yield continues to actually inch downwards after the bearish breakdown of this key major ascending trend line support that I drew from the low of 6th of April. All right, and what's interesting over here is that recent push up from 18th of July all the way up to 24th of July, this box over here. Then thereafter, in the last 3 days, it managed to shape that bearish reaction. All right, and where it shaped that bearish reaction is very close to this dotted red line, which is the pullback of that resistance, a pullback of that former major ascending trend line support turns into a major pullback resistance. And where does it confluence? It confluences right exactly at this two key moving average, which is the 200-day moving average and the 50-day moving average, all coming to act as a ceiling to prevent the price of this US 10-year Treasury real yield for breaching above the 2%/2.07% level. And what it means that, i.e., the trajectory is more heading towards the downwards to test the next medium-term support at this 1.79%. A breakdown below it gives us a retest of that February low this year at 1.62%. That means, i.e., the opportunity cost of holding gold is getting lesser, which could actually potentially supports this ongoing medium-term and major trend of gold. And if I overlay the gold chart at the bottom, you could see that last week rebound in gold over here, it actually rebounded right exactly at the 50-day moving average and also the median line of this major ascending channel that I drew from 14th of October low. Okay, so what you could see over here is that potentially it's still trading in the first half of this major ascending channel. And with this bearish reaction that's being seen on the US 10-year Treasury yield, it coincided with the bounce of this key positive element that I just highlighted for you guys on the gold price, the XAU/USD chart. So very clearly, if this US 10-year real yield continue to inch downward, it could be further potentially supportive of the medium term and the major term uptrend in gold price. This from a longer term perspective, not the intraday perspective. So because this is a daily chart, so this is kind of a intermarket play dynamics that's happening right now between the real yield, the real 10-year US real yield, and the gold price, XAU/USD. All right, so now one more chart I highlight to you is more pertaining to the US stock market. So if you look at the US stock market over here using where was, I think should be this level, yes, using last week price action on the individual candlestick. So let us start with the Nasdaq 100. What's Nasdaq 100 year to date is still number one because of the outperformance of the mega cap stocks. But if you look at the weekly candle, is rather bearish. We do see two consecutive with almost long black candle. All right, and also after the long black candle earlier, you see that spinning top that make this is the current all-time high. Spinning top with two bearish candle with a long body indicate to us that this could be the potential start of more of a medium-term corrective decline. And last week price action managed to also close below the 50-day moving average, increasing the odds that its medium-term uptrend has been more or less been damaged, all right, by the appearance of this long bearish candlestick, and it has a two consecutive basis. Yes, on the intraday basis, I agree that potentially we could see some form of snapback rally that is taking shape, which indeed took shape on last Friday. But however, from a medium-term perspective, over here is that after that bearish, after that mean reversion rebound on the very short-term basis ended, it could resume its longer-term or a multi-week trajectory push down scenario, given what we are seeing on the weekly candle last week on the Nasdaq 100. And we know that the Nasdaq 100 move has a direct correlation with the S&P 500 because the S&P 500 also have huge weightage in those mega cap technology stocks. What you see on the S&P 500, the price action also shaped very similar bearish candle on a weekly basis. All right, after the bearish engulfing that was being seen on the prior week. Much better than the Nasdaq 100 because it managed to survive at the 50-day moving average. But if the Nasdaq 100 going to inch downwards, it could actually drag down the S&P 500 as well. Like I explained earlier on, the S&P 500 majority, the heavy weightage is actually still concentrated on the mega cap technology stocks itself. Okay, but the reverse or the contrasting performance can be seen on the laggard. the current nugget, which is the Dow Jones Industrial Average. So you look at the Dow Jones Industrial Average, the weekly price action is almost different from the S&P 500 and the Dow Jones Industrial Average, the S&P 500 and the Nasdaq 100. As price action of the let me drag over. As the price action of the weekly price action on the S&P 500 managed to stage a bounce after a test on the 20-day moving average, and it still continues to hold above both the 20-day and the 50-day moving average. And where it bounced right exactly at the previous range resistance that has capping it since 18th of March all the way up to May this year. So it only staged a bullish breakout at the start of this month, where the outperformance of the value-oriented play takes shape due to the bull steepening of the US Treasury yield curve. All right, so it staged a bounce right exactly at a key medium-term resistance at the 39,890 level. And what's interesting over here is that the Russell 2000 also shapes similar price action movement over here, where it actually bounces off and even form a much more bullish Marabuzu candlestick, much more forceful and positive, more positive than the Dow Jones Industrial Average after that huge positive reaction for 2 consecutive weeks, right exactly after bullish breakout from this range resistance that is in play almost 2 years ago, 28th of March 2022. So that has a very significant positive impact on the Russell 2000. And don't forget, the Russell 2000 haven't even hit a fresh all-time high yet. The last all-time high it met was in November 2021. All right, so given this positive rotation play over here, we got to be respect the price action. That means those guys who are actually outperforming since the start of the year, the S&P and the Nasdaq 100 now will be taking a backseat. But why? Because it's being supported by the bull steepening. Later I'll flash you that particular chart again. And right now, the current nuggets for this year, coming year, is now actually pushing up the front seat, which is the Russell 2000 and the Dow Jones Industrial Average, all causing by the Fed that is giving us more signals or guidance that they are about to embark on the interest rate cut cycle rather than a hike cycle. All right, so this is what the bull steepening it means over here. Okay, let me very quickly open up the chart for you guys to see. Okay. Okay, let it load for a while. Okay, okay. So what you could see over here is that the top is a weekly chart, is the ratio I plot between the Dow Jones Industrial Average versus the Nasdaq 100, the Russell 2000 versus the Nasdaq 100, both in dark blue and turquoise blue. Okay, and you realize that both of these lines starts to inch upwards over here. So what we could see over here is that this price movement of the Nasdaq, okay, the Dow Jones Industrial Average and the Russell 2000 potential outperformance could take on the form between the ex-post COVID period, okay, of August 2022 all the way up to September 2022. All right, potentially, yeah. So why? Because at the bottom there's this, what causes this catalyst is the bottom of this chart over here in purple. This chart itself is actually the difference between the US 10-year yield minus the US 2-year Treasury yield. That means basically the US Treasury yield, the 10-year minus the 2-year. So previously, when it goes down to below zero over here, at the time was in July 2022, everybody was scared that the yield curve has starts to invert, the yield curve inversion. Because one yield curve goes down to zero, it represents softness in the US economy. And if going to inch downwards, it represents a potential hard landing then. So during this point in time, everybody was pretty much concerned, and the shift of the focus itself was heavily skewed towards the mega cap technology stocks. Why? Because the mega cap technology stock is considered as a new age defensive play because of their very high level of cash inflow that have been receiving in the last few years. But however, this yield curve inversion continues to inch, the yield curve inversion scenario continue to get uninverted since the start of this year, as this purple line continue to inch upwards. And this inching upwards of this purple line is caused by the 2-year treasury yield, especially in the last 1 month or so, that is dropping at a faster rate compared to the 10-year treasury yield. So that's a bull steepening, okay, representing to us that the Fed right now is turning much more dovish, and also the 10-year didn't collapse faster than the 2-year, meaning that the US economy is still in a Goldilocks scenario. Unless the 10-year fall much faster than the 2-year, that's a different story. That will actually start to see the yield curve inversion coming back into play, because that will be a hard landing scenario, indicating to us we are on the brink of a US recession. Okay, so as long as this bull steepening going to take shape, that means i.e. representing the US economy still has a chance of a soft landing, and the key technical level to watch out for in this yield curve is the negative 0.08%. So if you're going to break up above this red line here, that means potential for the bull steepening to actually get more enhanced and much more deeper into the positive territory. And when this happened, as what we could see earlier on over here in February 2022 all the way up to January 2021, it actually lead to the ratio. Oops, let me click again. Okay, sorry, let me, okay, good, it's a bit lagging. Okay, what you could see, the ratio of the Dow Jones Industrial Average inching upwards against the Nasdaq 100, the Russell 2000 also inching upwards against the Nasdaq 100 after the leading signal of a steepening of the yield curve that has taken shape much earlier. So this is something like a leading indicator. Okay, that the reason why I'm sharing with you, because it leads before the outperformance of the Dow Jones and the Russell 1000 take shape, and it could happen again. And right now it's already started to play out since the start of this month, and we got to respect this price action behavior. All right, so this is the current fundamental and more medium-term interdynamics scenario that is taking shape right now that I want to share with you all, of its importance to the global markets. All right, so now with that, let's take away from a medium-term perspective and now focus on the short-term intraday perspective. That means today. All right, so now let us now shift to the intraday technical outlook on the various cross asset classes, starting from the major dollar pair. So before that, let me expand my screen so that you guys could have a clearer look at the levels. Okay, so now let us go back to the chart again over here, focusing on the euro dollar first. Okay, so on the euro dollar, okay, hopefully it stays good. So on the euro dollar, the shorter term price action continues to trade above the 200-day moving average that is slowly rising. And since late last week, we do have a bullish bias, pardon me, about time twisting, we do have a bullish bias on the euro dollar. So still no change as price action continues to actually trade above this 20-day moving average. So from a intraday basis for today, we still maintain that short-term intraday bullish bias or outlook, using a Titan key short-term pivotal support as my level to actually maintain this potential bullish bias on an intraday basis. 1.0830 short-term pivotal support. First resistance level to watch will be at 1.0880, followed by 1.090 on the intraday basis. So these are the two key levels to watch. Only a breakdown below 1.0830 will negate today's intraday bullish bias to see extension of this potential slide to retest 1.0805, a breakdown below 1.0845. Why this level is important? Because it kind of confluence closely to these two key moving average, which is the 50-day moving average and the 200-day moving average. Only a breakdown below 1.0805 will unleash or unlash a much more deeper corrective decline to expose the next near-term support level at 1.0770. Okay, that's for the euro dollar. Now moving on will be the pound, the sterling dollar. So the sterling dollar, within our expectation, it continues to bounce right at the 1.2845 short-term pivotal support that we have for last week, and also continues to actually maintain right at the 20-day moving average after a retest of it this morning Asia session, this bounce over here. So with that, no change, still using 1.2845 as our short-term pivotal support on the sterling dollar. Still maintain that short-term intraday bullish bias being supported by this ongoing positive reading on the hourly RSI, still shaping a series of higher low. You could see over here, indicating to us there's still some form of short-term intraday positive momentum that is still playing out on the euro dollar, on the sterling dollar, pardon me, over here. Okay, so next near-term resistance level to watch, okay, will be at 1.2910 level, followed by 1.2940 level on an intraday basis. Okay, only an hourly close below 1.2845 will invalidate today's intraday bullish bias to see the continuation of this corrective decline scenario that has taken shape since 17th of July to expose the next near-term support level at 1.2780 on an intraday basis, also converging with the rising 50-day moving average that is acting as a similar support level as well at 1.278. Okay, that sum up the European currency intraday technical outlook. Now let us move on to the Asia Pacific dollar pair. Okay, starting with the Aussie dollar. So the Aussie dollar, oops, okay, the Aussie dollar continues to bounce right above the 65.20 short-term pivotal support level that we have highlighted on last Friday. So still no change, still using this similar level 65.20 as my short-term pivotal support level, also being supported by a series of higher low that has started to actually play out on its hourly RSI as well, indicating to us there is some form of positive momentum that is still intact on the Aussie dollar, and the RSI hasn't even hit the overbought region yet. First resistance to watch on an intraday basis, 65.80, no change, which is also correspond to the 200-day moving average, acting as this near-term resistance as well, followed by 66.10 level. So these are the two intraday resistance level to watch. However, if you have an hourly breakdown below 65.20, will invalidate today's intraday bullish bias on the Aussie dollar to see the extension of this impulsive down move to expose the next near-term support level at 64.65. That's for the Aussie dollar. Moving on will be the dollar yen over here. So the dollar yen going to inch up as expected, hit the first resistance level on last Friday before trading sideways itself. So for today, because it haven't have a clear breakout above the 154.10 level yet, I will still use the 151.70 as my short-term pivotal support level that converges with the 200-day moving average, rather than have a very tight support, short-term support, pivotal support at 152.70. So 152.70 will be my first support level, where price action in Asia session managed to actually bounce from this level, and we could see over here as we are speaking. But I don't put it so tight because it hasn't break above 154.10 level yet in today's Asia session. And what we could see is at the start of today's Asia session, there was a test of it before that two bearish hourly candlestick take shape. All right, there's some selling pressure at 154.10. So with that, 151.70 short-term pivotal support levels holds, still maintains the intraday bullish bias on the dollar yen. A breakup above 154.10 will see the extension of this potential mean reversion counter trend rebound scenario to unfold deeper into the next near-term resistance level at 155.80/156.50 level. So what's this level? Congestion area over here, 18th of July and 23rd of July. And if we do the Fibo retracement of this entire down move from the high of 3rd of July all the way down, oops, I think it's, let me redo it again. Okay, it's a bit lagging. Okay, good, it's successful. Okay, it's also close to the 38.2% Fibo retracement as well. All right, and slightly below the 50% Fibo retracement for the upper limit at 156.50. Okay, so that's for the dollar yen, and unless if you have an hourly close, hourly breakdown below 151.70, then this intraday bullish bias scenario will be invalidated to see the continuation of this impulsive down move of the dollar yen to expose the next near-term support level at 150.80/40. A breakdown below it exposes the 150 figure level /149.50. That's for the dollar yen. So that sum up the intraday technical outlook for today on the major FX pair. Now, with that, let us now focus our attention to the major stock indices, starting with the Hang Seng Index, Hong Kong 33. So for the Hong Kong 33, for today, it managed to actually stage a breakout above last Friday's short-term pivotal resistance level that we have. It can't break below last Thursday swing low at 16,970 on last Friday. So with that, that could actually start to shape a potential minor bounce scenario into play on the this Hong Kong 33 index as we are speaking over here. Okay, let me remove this short-term pivotal support. Okay, so first support level to watch out for today on the Hong Kong 33 will be at this 17,270, 17,815 level, 185 level, which is the 200-day moving average. That price action managed to reintegrate above it again over here. So using last Thursday and last Friday minor swing low area as my short-term pivotal support for today. Oops. Okay, this level here, short-term pivot. Okay, so this will be my short-term pivotal support for today on the Hong Kong 33, i.e. the Hang Seng Index, 16,970. First resistance to watch for this potential minor bounce scenario unfolding on the intraday basis, 17,517. Followed by 17,650, which is also confluencing with the downward sloping 20-day moving average. But however, if price action going to reintegrate back down and break below the 16,970 level again, that means the hourly close below it, then this impulsive down move sequence would continue on the Hong Kong 33 to expose the next near-term support level at 16,840, followed by 16,620. Okay, Japan 225. So Japan 225 continues to inch upwards. So on today's Asia session, it managed to hit the first resistance level at 38,750. So with that, we will have a tightened key short-term pivotal support for today, tightening up higher for today using last Friday's swing low at 37,630 level. So as long as 37,630 short-term pivotal support holds, we will still maintain our short-term intraday bullish outlook on the Japan 225. First resistance 38,750, above it exposes 39,350 on the intraday basis, which will confluence with the 50-day moving average acting as a resistance level as well. So these are the two key intraday resistance level to watch for today, 38,750 followed by 39,350. However, if we start to see an hourly close below 37,630, then this intraday bullish bias will be negated to see a retest at the key 200-day moving average acting as a support level at 37,105. Again, only an hourly close below 37,105 will unleash a deeper impulsive down move scenario unfolding to expose the next near-term support level at 36,495, followed by 35,685 next, which is the swing low area or the congestion area of minor swing low area of 26th of Jan all the way to 2nd of February this year. Okay, so that's Japan 225. Now moving forward will be the German 30 over here. So the German 30 or one of the major European stock indices. From last Friday, if you recall that we do have a bullish bias on the German 30. Why? Because the previous down move has already hit the lower boundary of this expanding wedge configuration in dotted purple line, not in dotted, but in purple line, pardon me, the lower limit that I drew right exactly at the low of 14th of June, and it managed to actually bounce off right it on last Thursday. And now going to shape higher high, broke above the 20 and the 50-day moving average, so very likely it's about to hit the upper limit of the expanding wedge scenario as well. So what I did that it hit the second resistance that we mentioned last Friday, 18,520. So right now the hourly RSI is already hit the overbought region itself. So potentially there could be a chance of a minor pullback taking shape again on the German 30 index on the intraday basis. So first level to watch on the pullback scenario that could unfold will be at this last Friday US session low, which is at 18,400 30 level. We also confluencing with the 20-day and the 50-day moving average, but I don't want to use this level. It's too tight because you realize that there's a key level over here at 18,350 level. So if you look at the 18,350 level very clearly, right, there is actually a very clear graphical representation. Previously it was an inverted V-shape burst out, now turns into a pullback resistance, and this burst up from the low of last Friday European session low all the way up to today's Asia session high. It also confluence with the gold. Oops. Let me withdraw it again. It also confluence with the golden ratio of 61.8%. All right. So using this graphical level, key graphical level, and the golden ratio confluencing at a similar level as well, 18,350 will be my key Titan short-term pivotal support for today. As long as this pullback didn't surpass below 18,350, we will still maintain that intraday bullish outlook on the German 30 or the bias on the German bullish bias on the German 30. First resistance level to watch 18,520, followed by 18,630 on the intraday basis. Then above 18,630 may see a retest on the 12th of July minus swing high at 18,770. Only an hourly close below 18,350 will negate this bullish bias. We'll see the setback scenario taking shape to retest the lower limit of the expanding wedge triangle or expanding wedge configuration at 18,150. A breakdown below 18,150 exposes the minor swing low area of 19th of June, 26th of June, and as well 3rd of July, acting as a support at 18,050. Okay, so that's for the German 30. Moving on will be the major US stock indices, starting with the Dow Jones Industrial Average. So Dow Jones Industrial Average last Friday hit our resistance level exactly at 40,564/40,670. And given the fact that the hourly RSI right now has already starts to inch downwards, attempting to inch downwards again after hitting the overbought region, that could be a sign of a minor pullback taking shape first because of this overbought condition that's being flashed out on the hourly RSI. And where is the short-term pivotal support that we have for today? So I'll have a Titan one at this former minor swing high of last Thursday at 40,380. So as long as this 40,380 holds in this pullback scenario taking shape, we will still maintain that short-term intraday bullish outlook after that pullback scenario may have unfold. So in fact, we could have a shorter pullback level to watch out for, will be this level here. All right. Okay, 40,580 first support level. Second support level will be the short-term pivotal support that I have today, the Titan one. So as long as this pullback didn't break down below 40,380, that means it come down here, this level here holds. Potentially, we may see another round of bullish upleg. So still maintain that short-term intraday bullish outlook on the US Wall Street 30, i.e. the Dow Jones Industrial Average. Next two resistance level to watch on an intraday basis, 41,050 followed by 41,250 level, close to the upper limit of this major ascending channel. That this line here, the turquoise green line, blue line, pardon me. Then, however, if you start to see an hourly close below the 30,380, then things might get choppy again. We'll see a retest close to the 20-day moving average, which is the minor swing low area of 25th of June level. So it could be a range level over here. Let me put it down. Okay, this is the 20-day moving average. Okay, 40,030 followed by 39,890 next. Okay, if 40,380 is broken down on the downside with hourly close below it. Okay, so that's the US Wall Street 30. Moving on will be the Nasdaq 100. So for the Nasdaq 100, almost hit the first resistance on last Friday, 19,230. Hasn't break out above it, so we do not want to shift the short-term pivotal support level. Still remains the same at 18,650 that we have on last Friday. So as long as 18,650 holds, these are the two key short-term resistance level to watch on an intraday basis, 19,230 followed by 19,520. Above 19,520 may see 19,780, which correspond to the former medium-term ascending trend line, distorted red line here, now turns into a pullback resistance and also confluencing with closely to the 20-day moving average as well. Only an hourly close, a breakdown with hourly close below 18,650, then all bets are off for that intraday bullish bias to take shape. Instead, we may see the impulsive down move of this medium-term corrective decline scenario unfolding to expose the next near-term support in the first step, 18,390, 18,360, followed by 18,125 next over here. Okay, so that's sum up for the intraday technical outlook on the major stock indices. Now let us move our focus now on to the commodities market, starting with gold XAU/USD. So for gold, last Friday we do have a bullish bias right exactly at the 50-day moving average. Price action hit the first support resistance level, 2,386 level. Okay, it already hit this level already. So now almost hitting the next resistance level at 2,411 level over here. Okay, so with that, we were actually, since they hit the first level, we could have a tighten key short-term pivotal support level for today over here. Okay, at this 2,373 level. Okay, so this one, let me put it normal. Okay, let me copy this over here. Oops, copy. Okay, let me change this. Okay, 2,073. Okay, this one will be a normal support level to watch. Okay, good. Okay, so now 2,000, this spot go. Let me shift it over here, okay, so that you guys could see. Okay, okay, let me open up the RSI again. RSI. Okay, so what I could see over here is that the RSI, okay, continue to shape a series of higher high, okay, in line with the price action. So there is no bearish divergence. Okay, so using a tighten key short-term pivotal support for today, 2,373 level, as long as the potential minor pullback holds above this level, still maintain that short-term intraday bullish bias on gold XAU/USD. First two resistance to watch on the intraday basis, 2,411 followed by 2,431. However, a breakdown below 2,373 will negate this bullish tone to see a retest of the 50-day moving average and last Friday minor swing low that was actually shaped that V-shaped recovery at 3,353. Only an hourly close below 3,353 will trigger a much more deeper corrective declines, or will trigger the continuation of that corrective decline scenario to expose the next near-term support level at 2,337 followed by 2,320. Okay, so that's for gold. Moving on will be the West Texas crude oil over here. Okay, where is the West Texas crude oil? Yes, okay. So the West Texas crude oil continues to actually break down on last Friday after a try to reintegrate on the 200-day moving average, but it shaped a bearish breakdown below the 200-day moving average, and it closed below that level on last Friday. So with such a bearish movement of the West Texas crude oil, we will flip to a neutrality stance over here. So we will have a neutral stance between 78.90, which is the 200-day moving average right now acting as a near-term resistance level, and 77.10, which was last Tuesday and almost last Friday minor swing low where you're about to break, but it shaped a sideways move price action on the intraday basis. So neutral between 78.90 and 77.10. Only an hourly close back above 78.10 will reinstate that potential mean reversion rebound scenario again for West Texas crude oil to expose the next near-term resistance level on the intraday basis, 80.30 followed by 81.20 level. Okay, so that's for West Texas crude oil intraday technical outlook, and also sum up our intraday technical outlook on the major cross asset classes. Okay, so before we go, let's take a look at the economic calendar for today. Right, so let me delete this. Okay, let me remove this. Okay, yeah, that's this week. Okay, so for today, over here on Monday itself, we do have a rather quiet session on Monday, so no key economic data to take note of on Monday. So, but however, this week will be a key big pivotal week. Why? Because we have a slew of major risk event taking shape from a economic data standpoint as well as an earnings standpoint. So what do I mean by this? So if we go all the way down to Wednesday, so Wednesday we will have the Australia inflation rate data that could impact the Aussie dollar pair and its Aussie cross pair out at 9:30 a.m. Singapore time on Wednesday. And also on Wednesday itself, we have the China manufacturing PMI data that's out. And most importantly, on a monetary policy basis, we have the Bank of Japan interest rate decision out at 12 p.m. Singapore time. And as well, it will also release its latest quarterly outlook as well. Okay, at 12 p.m. Singapore time on Wednesday. And on Wednesday, you also have the US Federal Reserve meeting that is on 2 a.m. Singapore time already, Fed decision, and 2:30 will be Fed Chair Powell press conference. And most important, on the next day itself, we have another central bank meeting, which is the Bank of England interest rate decision as well on Thursday. And with the focus on Friday, we have the US key job data report, which is the non-farm payroll. So this is a very, very big pivotal week in terms of the economic data releases. And in terms of earnings over here, so we do have a slew of the remaining US mega cap technology stocks that is reporting this week. So starting with this Tuesday, we have Microsoft reporting after the close of the market on Tuesday. Microsoft, then you go all the way down over here on Wednesday. We have Meta reporting at the close of the Wednesday US session. Then followed by, if not wrong, is Amazon. Apple and Amazon on Thursday at the close of the US session. All right, so that's why in terms of this week will be a rather pivotal and potentially volatile week as well. So with that, we'll talk about more about this key data as we take things one step at a time in this week's slew of daily dose market insights. So with that, that ends today's session. I'm Kelvin here signing off. So I wish you guys a great day ahead and we shall speak again tomorrow. Thank you.